Picking your first stock. Man, so many choices out there. I don't know what to pick, but I think I found the one. The math checks out. If the Dow Jones is up 25%, projected growth is positive, well, that leaves me with the low probability of a leveraged contraction period. I don't see another option. This has to be the one. Time to lock it in. Focus. Focus. You got this, man. You did all the research. Don't second guess yourself. This is crunch time. This is the perfect stock for you. I mean, really, what could go wrong? GoPro. No! So picking your first stock should go nothing like that. And in today's video, I'll be sharing with you 5 rules, 5 tips that you can follow that'll hopefully make your process go a little bit smoother. What is going on, you guys, and welcome back to another video here on the channel. My name is Brandon, and in today's video, we'll be going over 5 guidelines, 5 tips that you can follow to go out and purchase your first stock. And this should be a really good video for, obviously, a beginner to the stock market, if it's your first time going out and picking an investment, but also for current investors. If you're currently investing in something like a mutual fund or an ETF, and you're looking to kind of branch off or add some individual securities to your portfolio, well, the rules and the tips that we talk about in this video, they could be followed just as well. But diving right ahead here into rule number 1, and that is to identify exactly what type of investor you plan to be. And you need to be really clear on this. This is before you even go out and look at the options of investments you have out there. You need to dial in on whether you plan to be a growth investor, a dividend investor, maybe a high-risk investor, a low-risk investor. This all comes into play because you take, for example, a company, a stock like Fortis. That's a good example here for Canadians. And this could be an awesome stock for somebody that's 50 or 60 years old and they're about to enter retirement seeking some income. Whereas for a 21-year-old who's in a position where they're looking to grow and multiply their wealth, maybe they're better off looking at a company like Amazon. They're both good stocks, but for the right type of person, for the right investor. So the first rule is that you really need to focus in and really distinguish what is the strategy, what is the style that I personally want to follow, and then you can go out and pick your first stock according to that style. Now, once you've got that dialed in, the second rule here is to stick with the chips. Stick with the blue chip stocks for your first stock pick.
I want my chips with the dip, that's all I know. I don't want my chips plain, I want my chips with the dip. So bring them dips.
And I do totally understand. I really do get the allure of when you're fresh into the market, you want to go and swing for that home run. You want to look into something like a penny stock or maybe like a small cap or like a mining or like uranium company. I totally get that because there's a ton of potential there. But in almost all cases, when you're just starting out, a far better option is to lean on and rely on some of these established blue chip companies that have been around for, in many cases, hundreds of years. They've been through the ups and downs of the markets. They're often well managed. I'm not trying to say here that every blue chip stock out there will go on to be a great investment, but there's a significantly higher chance that you go on to do well with a blue chip rather than striving for, like I said, a penny stock or a spec stock right when you're starting out. A fun tip, if you're looking for some good blue chip stocks to own, go to Wikipedia and type in S&P 500 company list, or here in Canada, you could do the TSX company list. And then you can kind of go scroll through this list and see what types of companies you recognize. You won't recognize all of them, but the ones that you do, you can add to your watch list and do a little bit more research on them. Actually, a slightly more complex or advanced tip is you can actually go look into some popular mutual funds. You can actually go see publicly what the top holdings are in these funds. And that gives you an idea into what some of the portfolio managers are doing, where they're seeing value. It's not a reason to go out and copy them, but again, just to get some ideas. Now, moving on to tip number 3, here's a good one. It's aim for a stock that pays a dividend. And certain stocks that you go out and buy, they'll actually pay you every 3 months. They'll pay you a little income payment, a little cash stream into your portfolio simply for holding the stock. And whether you're planning to be strictly a dividend investor or not, for really anybody out there, when you're just starting out for your first investment, it's tough to go wrong with a good quality dividend stock. And that's because when a company is able to pay a dividend, that usually shows signs that the company is financially stable. If they're a company that's making consistent profits and they're managing their cash flows effectively, they're able to take some of those profits and pay them back to the shareholder, that's usually a good sign. Not to mention that when your stock pays a dividend, even if the share price temporarily drops down, you're still receiving that dividend payment. You still get that stream of income, which of course is an added bonus, and it just makes things not really feel as bad when you see your stock dropping, knowing that you're getting a little stream of income along the way. Moving on to tip number 4, and this really has to be my favorite of the bunch. Go out and choose a stock or choose a company that you personally use, love, or support. And I always like to say, we don't want to get too emotionally attached to a specific investment, but at the same time, it's awesome to have a connection, especially with that first stock that we go and add to our portfolios. And let's not forget here that when we go out and purchase a stock, we are literally going out and essentially buying a tiny portion, a tiny sliver of that company. We are inherently becoming business owners, part owners of the underlying company. And you look around you to the different products and services that you use, it makes sense to go out and pick a company that you currently support and you'll see doing well years into the future. A great tip here for Canadians is to look into something like where you personally bank, something like TD Bank, Royal Bank, or BMO. Another good example is your provider in terms of your network or your internet. Maybe if you're over in the States, you're somebody that likes to drink a bunch of beer. Well, take a look into a company like Anheuser-Busch, the company that produces Budweiser. It's fun to invest in companies that you are a personal consumer or supporter of. Now, rule number 5 here, the last rule is to go out and find a company that is currently trading below its intrinsic value. And notice this is the last step here. If you've actually gone out and by now you have a couple stocks in mind, maybe some big blue chip companies that you personally use and support, if they pay a dividend, well, that's awesome. Well, when you're actually ready to go out and purchase and add that stock to your portfolio, you want to look at the scope of options out there and you want to target an investment that's currently showing some value, that's currently trading at a good price. And I think to an example like Procter & Gamble at the moment, as of filming this video, this is one of my favorite blue chip companies out there. I love their products. I use Tide, the Gillette razors. It pays an awesome dividend, but at its current price, I don't think it's showing value. In fact, I'd consider this stock quite expensive after this pretty nice run up that we've seen here. So despite loving the company, I wouldn't choose to buy it right now. We want to instead be looking for really the opposite of this. And I think to a company like Activision Blizzard, which I've been buying after this big drop, or even the Chinese company here, Tencent, just for a couple examples, these are a couple examples of stocks that I believe are trading on more of the cheaper end of the range. You can kind of see the difference by comparing their share prices there. I know these two don't pay dividends, but I think you get my point here. And this is where our watch list becomes very important. If you're getting started with investing, you all should have a watch list where you're adding companies, solid investments that you'd at one point like to own or at least keep on your radar. And from time to time, you can check in and see if any of these opportunities are presenting themselves. So those right there are 5 rules, 5 tips or procedures that you can follow in terms of going out and picking your first stock. If you go out and follow that procedure, you'll probably find your hands on a pretty decent investment. I think back to when I bought my first stock, it was actually 2. It was the companies McDonald's and Coca-Cola. And this goes back over 10 years now. I still own those 2 stocks today as core positions in my portfolio, and they've done very well for me over the years, not to mention the amount of income that I've pulled in. And to me, that's really the way that you want to approach picking your first stock. You want to have a company that you can take with you for the next 5, 10, 15 years. A company that, again, you support, you're happy to own, you have a connection with, and that will reward you in terms of returns, as well as the income from the dividends if you do decide to go for a dividend stock. So if you guys enjoyed today's video, feel free to give it a thumbs up. If you're not already subscribed to the channel, we post a video like this every week, so make sure you subscribe and hit the bell for notifications. If you are a beginner investor and you're looking to learn more, you can check out our Investing Academy. It's that first link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.